3 politicians bet on their own races, and Kalshi turned those tiny wagers into a much bigger test of whether prediction markets can police themselves. The pressure point is simple. Candidate wagers triggered fines, suspensions, and a wider credibility test for event markets. They bet there is the search phrase, but the useful issue is who gains, who loses, and which rule or right changes in practice. That is why the practical rule change matters more than the political slogan around it. Kalshi said new safeguards flagged the trades, leading to fines for Matt Klein, Ezekiel Enriquez, and Moran, as well as 5-year bans from the platform. That is a bigger deal than the wager size, because the platform is trying to prove it can act like a market venue instead of a novelty app. This puts a real procedural marker on the story instead of leaving it at rhetoric. Moran described his wager as a deliberate stunt to test enforcement, while Klein said he placed a small trade out of curiosity and later apologized after learning it violated platform rules. In plain English, insider trading here means someone can influence the outcome they are also trading on. Once the formal structure appears, the winners and losers become easier to identify. For people typing they bet there, the practical issue is enforcement, access, or voting power, not the headline alone. The crackdown landed as prediction markets were already handling billions in volume and facing more questions about insider trading, conflicts of interest, and whether event contracts are drifting too close to gambling law conflicts. That is the step that turns a debate into operational consequences. The mechanism is credibility. A platform can claim transparency and price discovery, but if participants with inside leverage can trade on their own outcome, the market stops looking like a neutral signal and starts looking manipulated from the inside. Anyone searching, KW, is really looking at a credibility test. Can these platforms police unfair edges before regulators do it for them? The legal mechanism matters because markets adapt to rules long before they adapt to narratives. That matters to everyone using these venues as hedging tools or information markets. If the rules are weak, contract prices carry less trust. If the rules are enforced, platforms may win a better argument for mainstream financial legitimacy. The stronger the enforcement line becomes, the stronger the argument that event markets belong inside mainstream finance rather than outside it. This is where affected users, platforms, or investors start calculating real compliance or access costs. What remains unclear is whether reactive platform enforcement will be enough once volumes keep scaling, or whether regulators and lawmakers will demand tighter onboarding, monitoring, and disclosure rules across the sector. Watch for how rivals update their policies, how often these cases become public, and whether enforcement headlines slow adoption or actually reassure users that event markets are trying to act like real markets. The open question is not cosmetic. It decides how much room the market actually has. That leaves they bet there hanging on the next formal step, because speeches and posts matter less than enforceable rules or court filings. Prediction markets want the credibility of finance, and stories like this decide whether they can earn it before regulators impose a harsher version from the outside. The next official move matters more than another round of commentary.